we have the techniques. We have the techniques that you can use to ascertain the system. Like one, you can have a discussion with the client's officers. Just have a discussion with them. Have a discussion with the client's management. The other one, you can also review the system manuals. You can review the system manual. You can review the system manual. You can review the system manual. The other one, you can do what you call this. You can use a descriptive questionnaire. Use of 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 a descriptive questionnaire. We can also use observation, just being physically present and observe. Observation, observation, observation. So those are the techniques we can use to ascertain the system. After that one, we go to the next stage of an audit, number 5, performing compliance. Performing compliance test. Performing compliance test. So let me add this. Performing compliance test. So just ascertain the system. The next procedure is to perform compliance test. Now, the other term for compliance test, in order the test of control. Test of control. The test of control. The test of control. So tests of control, they are done to achieve only 2 things. The test of controls are done to achieve only two things. One is just to confirm if controls, whether, the best word is to use whether controls exist. If you want to establish whether controls exist, you perform what you call the compliance test, whether the controls exist. That's the one aim of performing compliance test on the client system, whether controls exist. Are controls in place? The other one objective is to confirm whether controls are effective. Whether controls are effective. Whether controls are effective. Whether controls are effective. And what tells you whether they're effective? If they have the capability of preventing and detecting errors and fraud. If those controls put in place, they have capability of preventing and detecting errors and fraud, we said yes, they are what? Effective. They are effective. Those are the reasons why we perform what we call compliance test or the test of control. So anytime you come across a term, compliance test, just look at the test performed on the system to determine whether controls does exist and whether effective in detecting and preventing errors and fraud. Compliance test or test of what? Control. The next stage of an audit, that's number 5. Number 6, now we have what we call performing substantive test. Performing, that should be number 6, performing substantive test. 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 The other term for substantive tests are tests of detail. Tests of detail. The test of detail. The test of detail. That's another term for substantive test. So as a class, substantive tests are tests done on what? These are tests done on classes of transaction. They are tests done on the classes of transactions. They are tests done on the class of the transactions and balances. And balances. They are tests done on class of transactions and balances to confirm whether they are complete, whether they are complete, accurate, and valid. So the substantive tests are performed on the class of transactions and balances. to confirm whether they are complete, accurate, and valid. So that's what's meant by the term substantive test. Basically, the test performed on the class sale transaction and balances to confirm are they accurate, complete, and also valid. Then we go to number 7 stage of an audit. Number 7 stage of an audit is performing the final analytical review procedures. Analytical review procedures. Analytical review procedures. Performing the final analytical review procedures. Performing the final analytical review procedures. In short, we refer to them as we use the acronym ARPs. The ARPs. Performing the final analytical review procedures. So we say final because these ARPs are performed in 3 stages of an audit. They are normally performed in 3 stages of an audit. The ARPs, either the planning stage, you can perform the ARPs just to identify some of the problem areas for attention. You can also perform them during the audit. You can also perform the ARPs along with the point of concluding an audit. At the point of concluding an audit, you can also perform the analytical review procedures. If you want to read more on the analytical review procedures, we make references to the ISA 520, the International Standards on Auditing 520. We get more discussions on the analytical review procedures. Now, I always say remember, ARPs are just reasoning procedures. They help an auditor to understand some of the inconsistency of the audit evidence obtained by other procedures. So to be able to get that inconsistency of the audit evidence obtained by other procedures, either compliance test or the substantive test. So they help auditor to understand those unusual items. These are unusual items where the managers can be put into task to explain and to give more evidence about those unusual occurrences. There is a very simple way of conducting what we call analytical review procedures. There are simple ways of conducting. It's not something very difficult when you talk about ARPs as a way of getting some more information with regard to some unusual occurrences. So we have examples of ARPs. One is what we call ratio analysis. Ratio analysis. One of the example of analytical review is ratio analysis. Ratio analysis. The ratio analysis. You as an auditor, you get financial statements, then you conduct some ratio analysis. You know how ratios are used. You have a number of ratios: profitability ratios, liquidity ratios, the gearing ratios. These are ratios mingi. So there is a point where you, as an auditor, you may use them as part of your analytical review procedures. Like one, you have this common ratio, the current ratio, whereby the current ratio is equal to current assets over current liabilities. So you get an extract of the balance sheet. So let's say when we have different periods, 2022, then 2023. So once you have completed these particular ratios, you find that 2022, the ratio is 2 to 1. 2023, the ratio is 1 to 3. So these are what you have come up with in terms of the computation of the ratios for comparative purposes. So there is something which is not right here, or there is a negative trend in the working capital management of this firm. So it will require the managers to be able to tell what happened in the year 2023. Why are things so bad in the year 2023 with respect to the year 2020? Because hapo ukiangalia, the current assets cover is at twice the current liabilities. So in terms of meeting the short obligation, whenever they fall due, this business is not struggling. They are able to meet that one. They are able to pay their suppliers on time, the creditors on time. Come here 2023, things are now bad. The liabilities, the current liabilities have outgrown the assets. The short-term obligation cannot be met efficiently by the firm. So the manager should be able to tell you what happened hapa sasa. Bona hii negative trend. And that will form part of your valuable audit evidence. Maybe hapa, one of the major customer pulled out. They may get a very good results to tell you as part of your valuable what? Audit evidence. So that's one way of performing what you call analytical review procedures through the ratio analysis. The other way is a trend analysis. Another example of the analytical review procedures is what we call the trend analysis. Trend analysis. Trend analysis. The trend analysis. Trend analysis. So trend analysis, it helps you to tell or to gauge where the business are moving towards a positive way or a negative way. A negative way. So it's a best demonstrator using certain line graphs. It's a best demonstrator using certain line graphs. For example, given two periods, period one, let's say two variables, sales against time, the sales against time, sales against time. So in period one, the graph is like this. That's the pattern you get after plotting the sales and the time for a certain period of time. In period two, you get something like this. So sales against time. You find kwamba it's negative, it's dropping. So managers will be able to tell you what happened in period two. Why did the sales went down with the time? Unlike in the previous period where we saw the sales were growing. So that's another way of performing analytical review procedures by auditing the trend analysis. The other one, you can do what you call the reasonableness checks. Number 3 example, reasonableness. The reasonableness checks. Reasonableness checks. The reasonableness checks. And a very good example of this is whereby unapewa the budget figure and also the actual data. So it's being presented the budgeted data, along with the actual. Let's say, for example, it's for the material price. The material price, you have the material price. Material price. So material price budgeted was 300 shillings per unit. The actual turned to be 700 shillings per unit. So there is a variance here which is negative 400. There is a adverse variance upper which is at negative 400. So you ask the managers now to explain it, because they had budgeted to buy material at what? 300. But they later went and buy at what? 700. So what happened? They'll give you a very good evidence. Either it was due to price fluctuation, or they had to source for a supplier who was charging higher prices compared to the budgeted suppliers. So those are the ways on how we conduct analytical review procedures. We have a topic for that. We have a topic for analytical review procedures, are very important procedures performed in an audit. So I find again for the management of an auditor practice. In fact, most likely you can be tested all analytical review procedures as per the provisions of ISA 520. So we are done with that. The next one is we stage number 7. So stage number 8, concluding an audit. Stage number 8, concluding an audit. Concluding an audit. Hapo ukipenda you can put as a audit finalization. Auditor finalization. Audit finalization. Concluding an audit or auditor finalization. So before you draw an audit opinion, you must be able to finalize the audit. Now there is a number of standards that are being followed when it comes to audit finalization. Concluding the work is you're now closing the job. The things that we take into consideration as part of audit finalization. So concluding the audit, concluding the audit. So the things that we take into account, the activities done, Like number one, we have what we call the overall. Sorry, not the overall. Let's just talk about audit reviews. Auditor reviews. You have to undertake the auditor reviews. You have to undertake audit reviews. You have to review the work. You have to review the work, and doing so, you are trying to meet the quality of the audit, the quality of the audit. So what we're being done by what we call the quality controls. Quality controls. You're trying to adhere to the various quality control procedures are put in place. The various quality control procedures are put in place. The various quality control procedures are put in place. Now here, on the quality controls, you follow what you call the ISA 220, ISA 220, the International Standards on Auditing 220, in conjunction with the ISQC, the International Standards on Quality Control 1. That's a very important component we shall be discussing also in this class. There's a topic for quality control when it comes to engagement review assignments. The other one that you also consider as part of audit finalization activity is subsequent events. Subsequent events review. Subsequent events review. Subsequent events review. Subsequent event review. Here, you look at the ISA 560 and IAS 10. The ISA 560 and the IAS 10. The International Accounting Standard are 10. We know what to call the subsequent events. These subsequent events can be either subsequent events, we know them. They can be either what? Adjusting events, or non-adjusting events. The non-adjusting events. So there are two types of subsequent events. The adjusting events and the non-adjusting events. They are adjusting events and the non-adjusting events. There are two categories of subsequent events. Hizi tunajua tuko na information about them. Tuko na information about such kind of events are happening. Tuko na information about this. So tuko na what you call the financial reporting period or date. Financial reporting date. Then tuko na auditors report date, auditors report date. Then you have what you call the financial statements issued. Our financial statements authorized for issue. Financial statements authorized. Authorized for issue. The date authorized for issue date. Then the last one you have the AGM date. Date of AGM. The date of AGM. So we always have this period up. The date when the financial statements are being compiled and complete. The date when the auditors have done the job, they're giving the report, they're signing their report. The date when the board sits and issue the financial statements now becomes a public utility document. Then the date when the shareholders convene or they come for the annual general meeting. So you have events occurring here. Different events occurring from this period to somewhere here, alafu zinaendelea like that. So these events inaitwa subsequent events. The events whose facts or conditions are known to the auditor after the reporting period. After the reporting what? Period. So kama they existed upper the financial reporting date. but they became known to the auditor later. All the rows later, they are what we call adjusting what? Events. Yes, this is another area that we shall be discussing. We put a topic at this one up for audit reviews. We have a subtopic for subsequent events. So one of those facts that existed here, but became known to the auditor after this reporting date, after this one happened, those subsequent what? Events. Then for those ones which do not provide evidence of the existence here, but those who arose later, known as non-adjusting what? Events. So per the accounting standard IAS 10 requires that if identified adjusting events, then the financial statement should be amended. Those changes has to be incorporated in the financial what? Statements. For non-adjusting, just a disclosure in the notes of the accounts. So don't worry about that one. We shall be discussing them in another area. We have a topic for the subsequent events, which is a examinable area in this unit. So that's another concerns as part of the audit finalization. The other one is the other activity considered as part of audit finalization is going concern review. Going concern review. Going concern review. Going concern review. The going concern review. The going concern review. So on the going concern review, on the going concern review, okay, on the going concern review, we are guided by the ISA 570 with an accounting standard IS1. IS1, the going concern review. So when it comes to the review, we follow the ISA 570. Accountants or the managers, as they prepare the financial statements, they need to subscribe to the IS1, which says that the financial statements should be prepared on the basis of the going concern. It must tell that the entity is a going concern. And if the going concern is doubtful, there is a way the financial statements ought to be prepared. The other one is a management representation. Management representation. Management representation. Management representation. The management representation. So here we follow the ISA 580, the International Standards on Auditing 580. So that's a letter. That's a letter that provides an evidence to the auditor. Is a letter that's normally also required to be produced by the managers because it gives more evidence to the auditor, or it also confirms some of the oral or the verbal discussion that took place between the auditor and the client management. So class, those are the things that we consider as part of the auditor review or the auditor, as part of the auditor finalization or concluding an audit. So as an entire topic of the audit review, we shall be discussing all those areas. Like in this unit, you are required to know how to draft a management representation letter. So we shall be guided to figure that particular point by looking at these various aspects. Then the last one is drafting and signing an audit report. Drafting and signing an audit report. Drafting and signing an auditor report. Drafting and signing an auditor report. Drafting and signing an audit report. So that's one we are guided by the ISA 700. The International Standards on Auditing 700. The International Standards on Auditing are 700. So we are drafting and signing auditors a report. Then maybe the last one is submitting the auditor's report. Submitting the auditor's report at the annual general meeting. Submitting the auditor's report at the annual general meeting. Submitting the auditor's report at the annual general meeting. So class, those are the stages of an audit. For audit to have to be completed, Those stages must be duly followed by the auditor, right from the engagement to the time is available at the AGM to present the report to the members. It's very important for us to have that idea of the stages under which an audit is normally conducted. Sasa no, wacha kuangalia nyuma wende na kuongelesha. So after doing that, is auditing just about talking and talking. So we still continue our talking. So I want to take you to another area also that's also quite very important. We have this knowledge. It's good for us. So kuna kitu network types and classification of audits. Types and classification of audits. The types and classification of audits. The types and classification of audits. We need to do some of these things. We have this idea, should have these ideas. The types and classification of audits. So class audits are divided into two main categories. We've got only two main categories of types of audits. Types of audits. So for types of audits, tuko na two main categories. The two main categories of audits. The two main categories of audits. Ya kwanza, you have what you call external audit. External audit. External audit. External audit. We have external audit. This external audit is further divided into external audit is further divided into what you call the private audit. Private audit, also known as statutory audit. The statutory audit. The statutory audit. So the private audit or the statutory audit. They also have the public audit, which is also known as the non-statutory audit. The non-statutory audit. The non-statutory audit. The non-statutory audit. Then this side we have the internal audit. Internal audit. Internal audit. So those are the types of audits we have. Those are the types of audits we have, plus the internal or external audit. So, kuna vizuri for us to know the difference on the external audit and the internal audit. Inafaa tukuwe na hii idea and understanding what's the difference between internal and external. The difference between the two. So, kuna number of bases we can use to differentiate these people here. Like, what is the objective of these audits? Objective, the external and internal. Objective external audit is just for the auditor to examine the financial statements and express an auditor opinion. That's the objective of the external audit. Yes, come examine the financial statements and express any opinion. The objective, the internal audit is to examine now the procedures and activities. Just to examine the procedures and activities to determine whether they are efficient, effective, economical, and give recommendations for improvement. Give recommendation for improvement. Then the other one is a focus. The focus of these two audits. So external audit now focus on the financial statements. It focuses on the financial statements. While the internal audit in a focus on the procedures and activities. So the work It focuses on the procedures and the activities. On the procedures and the activities. So external audit focus financial statements. Internal audit on procedures and the activities. The other one is on the appointment of these two persons. Appointment. So the appointment of the external auditor is effected by the shareholders. It's the shareholders who appoint the external auditor. So external auditor is appointed by the shareholders. This person is appointed by the management. Internal auditor is appointed by the management. Is appointed by the management. The other one is in terms of what we call reporting. Reporting. External auditor reports to the shareholder. We have a report for the shareholder. External auditor reports to the shareholder. External auditor reports to the shareholder. Then internal auditor reports to the management. Internal auditors reports to the management. Reports to the management. The other basis is on what we call remuneration. Remuneration. That's the pay. So we, external auditor, is compensated by by audit fees. Yes, the external auditor is compensated by auditor fees. They earn an auditor fee. Internal auditors, they are employees. They earn some salaries. So their remuneration is salaries. The other base of the difference is what we call the scope of work. Scope of work. The scope of work. So the scope of work is in terms of the duties, responsibility, and the extent of procedures. It is in terms of the duties, responsibilities, and the extent of procedures. Such a we external auditor. The scope of work is determined by the Company Act, and ISAs. The scope of work of the external auditor is determined by the Company Act and the ISAs. That means that the Company Act fixes the external auditor's duties. The duties of external auditors is determined by the Company Act. The way it comes to the procedures of performing an audit is determined by what we call the ISAs. The procedures to be performed by the ISAs, the extent of the work, the nature, the time, and the extent of the work by the ISAs. Okay, this internal auditor, the scope of work is determined by the management. It's the manager who fixes the internal auditor's responsibilities. It's determined by the management. So the other one is in terms of liability. Another area of difference is in terms of liability. The liability. So external auditor has a liability both for the company and third parties. They have a liability both for the company and third parties. While the internal auditors only with the company. Their liability is only within the company, Okay, so those are some of the differences between internal and external audit. So there is a topic we shall be covering something with respect to internal audit function, so that we get to know what are the functions, the responsibility of the auditor. There is an area of a relationship between the internal auditor and the external auditor. There is an area of relationship between the internal and the external auditor. It's good for us to know what are the assignment or the work that can be done by the internal auditor on behalf of the external auditor. There are also the factors that the external auditor will consider before relying or placing reliance on the work of the internal auditor. So much on the internal audit function. Nakonga the ISA 710. Much of the internal audit matters is a 710 for much with the internal auditor functions. But we did also mention that external is either private, so this should be public, not private. Is a public in the come on the statutory. Then this is the private. This is a private. This is a private. So public inajulikana kama the statutory audit. So this is done as a legal requirement. This is a mandatory audit. This is a mandatory audit for the limited liability entities. This one upper is a mandatory audit. This is done voluntarily. Private is done voluntarily at the express request of the partners or the sole proprietors. They may ask for a private audit. So kuna tofauti between this and this. This one up, the report is a public utility document. The report of a public audit is a public utility document. This one up is a non-public utility document. That document is only available to the business owners or the shareholders for that entity only, and not members of the public. So that's some of the types of audits. So lastly, I want us to go to what we call classification of audits. Classification of audits. Classification of audits. So class, we have a number of bases of classifying audits. We have a number of bases of classifying audits. We have a number of bases of classifying audits. You have a number of bases of classifying audits. I just want us to go through some of these bases of classifying audits. Classification of audits. Classifications of audits. The classification of audits. So number one, we have classification according to nature of work done. 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 So these ones are normally the base of what we call the legality of those audits, the legality of those audits, and the persons involved. The legality of those audits and the persons are involved. So they include either a internal audit, external audit, external audit, private, you can say public audit, then private audit. So those are the four audits, and the nature of the work done being defined by either the legality of those audits or the persons. Like upper is based on the persons. These are based on the persons involved. I love these ones based on the legality. Maybe also the legality aspect of it. The legality aspect of it. Okay, next category, next classifications are classification according to audit timing. Classification according to auditor timing. Classification according to audit timing. Classification according to audit timing. So this is based on the period under which these audits are performed. The period of the duration under which they are performed. It's based on the period or the duration under which these audits are performed. So these audits are normally done to meet a specific interest. They are normally done to meet some specific interest. So they include one, what we call the interim audit, an interim audit, B, continuous audit, C, we have got final stroke complete audit. The final stroke complete audit. Okay, these ones are things that we did in our lower levels. So interim is done at a regular time intervals. It's a type of an audit done at certain regular time intervals. This occurs maybe after 3 months, 9 months, 6 months, etc. On this one, Sapa, we audit the interim financial statements. We examine the interim financial statements. It's a ideal type of an audit when it comes to declaration of the interim dividends for the company. Declaration of the interim dividends for the company. So before that, this audit might be requested. So in terms of assurance engagement, interim audit is known as a limited assurance engagement. A limited assurance engagement. A limited assurance engagement. A limited assurance engagement. The interim audit is known as a limited assurance engagement when it comes to the classification of assurance engagements. Interim audits are limited. Continuous audit is done as soon as the transaction of the business are processed throughout the financial reporting period. The reason why it's ideal for manufacturing concerns, for the banks, insurance, because of the nature of the environment under which they are operating. Very dynamic, now there's a lot of risk. So it calls for continuous audit. Now, also the volume of the transaction, where there is increased volumes of transaction, continuous audit will be ideal so that the fouls and errors can be detected much earlier and action taken for their correction. Final is done towards the end of the reporting period. At the end of the reporting period. At the end of the reporting period. It can be done as a final work of the interim or continuous audit. Then we go to the next classification, is a classification according to audit approaches. Number 3, classification according to audit approaches. Classification according to audit approaches. Classification according to audit approaches. So these are partial audits. These are partial audits. They're also done to meet certain specific objectives. So they include, like, 1, we have the procedural audit. Procedural audit. So here we are examining the procedures to give recommendations on the improvement. Then B, we have compliance audit. Compliance audit, we're checking does the entity complies with the rules and regulations put in place. You have the management audits. So you're investigating the managers, their decision-making process, how effective are they, how efficient are they. B, operational audit. Operational audit. The other name for operational audit is a value for money audit. The value for money audit. Value for money audit. There's another term for the operational audit. In the public sector, we do refer to it as a performance audit. There are three E's basis of conducting operational audit. The 3 E's basis of conducting operational audit. Either efficiency, effectiveness, economy. So the 3 E's basis of conducting a value for money audit. You ask yourself, how efficient are we in terms of using the available resources? How effective are we in terms of attaining the set objectives? How good are we in terms of our benefit vis-a-vis the cost? Then the last one is the balance sheet audit. The balance sheet audit. So as an approach of audit, you begin by taking the balance sheet, then you audit as we go backwards to the source document. So now the balances the balance sheet, then you go to the source document. You're trying to trace it. Are they accurate? Are they complete and and valid. There's a word on public is a statutory audit, then private is the non-statutory audit. Is a non-statutory audit. So we have those ones as a classification according to audit approaches. The next one is a classification according to audit strategy. 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 Classification. Classification according to audit strategy. Auditor or strategy. So what influences an auditor strategy used by the auditor are only two factors. The only two factors is either one due to the nature of the internal control system, ICS, and what you call risk. These are the two factors that will influence which strategy to be used by the auditor in auditing work. So either the internal control system or the risk. So when it comes to, these audits include two kind of vouching based. The vouching are based. The vouching based audit strategy. The vouching based auditor strategy. Two, we have the system based auditor strategy. C, we have what we call the risk. The risk-based audit strategy. The risk-based auditor strategy. So we have the vouching, we have the system, we have the risk. So these in Billy Upper are influenced by the nature of the ICS. The vouching and the system-based are influenced by the nature of the internal control system. Alafu ya mwisho hapa is the risk factor. The risk factor, the risk-based audit, the risk need focus. We shall go for the risk-based audit approach. So let me take you to what happens for auditor either to take a vouching or a system-based auditor approach. So the things that auditor do before determining which strategy they will use, So kitu ya kwanza, auditors must undertake what you call ascertaining the system. Ascertaining the system. Ascertaining the system. This is the very first thing auditors should be able to do. Ascertaining the system. Understand that system. That's the first thing as an auditor you should be able to do as part of your audit procedures. Then is followed by documenting the system. Documenting the system or recording the system. Or recording the system. Document the system or recording the system. That is the second stage. Documenting or recording the system. So when you document the system, you demonstrate that you understand the system. So you demonstrate your understandability of the system. There are techniques that you can use for documenting the system. Next, we go to evaluating the system. Evaluating the system. Evaluating the system. Evaluating the system. You evaluate the system. Evaluating the system using various compliance testing procedures. And from there, Sasa, we have these two things up, outcomes now. So I begin this side. You find that the system is weak. The system is weak. The system is deficient. Ineffective. Ineffective. The system is weak, ineffective. So upon evaluation, we find the system to be very weak. The system is ineffective. The system is ineffective. So what happens? What action will we take? Don't place reliance on the system. Don't place reliance. Don't place reliance. So you find the system is weak, don't place reliance. Don't place reliance on the system. If it has come to your knowledge that it is weak, don't place reliance. And if you don't place reliance, you're going to adopt vouching based strategy. Adopt vouching based strategy. Adopt vouching based strategy. You adopt the vouching based strategy. You adopt the vouching based strategy. Then you have to increase the substantive procedures. Substantive procedures. Increase the substantive procedures. Increase the substantive procedures. Increase the substantive procedures. Increase the substantive procedures. So I wanted to, I want to be able to do that. So increase the substantive procedures. Then you come to this side upper. So here we have what you call, we have found the system to be strong. System is a strong. System is a strong. System is a strong. It is effective. It is effective. The system is strong. It is effective. Effective. So here you're going to place reliance on the system. Place reliance. Place reliance on the system. Place reliance on the system. You place reliance on the system. You place reliance on the system. Then you adopt a system-based approach. Adopts a system-based strategy. Based a strategy. Adopt a system-based strategy. Then you are going to do limit the substantive procedures. Limited procedures. Limited procedures. Limited procedures. Limited procedures. Limited procedures. Limited procedures. So those are the activities which take place when it comes to determining auditor strategy to be used. So upon evaluating the system, you find is a very strong, then you adopt a system-based audit approach, a strategy. When it's weak, we adopt a vouching-based strategy. It has the implication in terms of amount of work. If the system is very strong, you are going to reduce your procedures. You are going to reduce your sample size. If it is very weak, you have to increase the sample size. You have to increase the procedures. You have to perform increased procedures. So that's audit classification. Number 4, go. You're about to finish. You're about to complete. So we go to number 5. We go to number 5. We go to number 5. So number 5 is a classification according to organization structures. Classification according to organization structures. Classification according to organization structures. So on the classification according to organization structures, we have these audits. We have what you call the branch audits. Branch audits. You have the joint audit. I'll have the last one took on a group audit. So the branch audits, you're auditing the branches. You do what you call a branch audit. When you're auditing consolidated financial statements for the holding entities, when I find the group audits. Then took on a joint audits is a collaboration kind of audit, where more than, two or more auditors. The 2 or more auditors doing a work, then give one report. Joint audit. You have audit firm A combining effort with the audit firm B. Then they give only one one report. It's a joint audit. A joint audit where two auditors or more working, then they give only one report. So you need which classification is that? Number 4, number 5. Then you go to the last one. Classification according to the societal needs. 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 Yeah, such is about being responsible. You have the corporate social responsibility. The society wants a responsible company. They are very sensitive in terms of addressing the society issues or the concerns. So in such a case, such kind of audits will be required. So example took on environmental audits. Environmental audits. Number 1, environmental audits. Environmental audits. You are auditing environmental matters, environmental compliance, etc. Next, we're going to social audit. Social audit. Social audit. On a topic for that, we shall be covering those audits, environmental audits and social audit. In a topic, audit for the related assurance services. We shall come into more detail about these two audits, environmental audits and the social audits. I'll have the last one to on a forensic audit. Forensic audit, forensic audit, forensic audit. So forensic audit, you have also a topic for that, forensic accounting, which we shall be covering. So that's what I wanted us to have idea when it comes to the types and the classification of audits. Classification of audits. So lastly, in the next few minutes, I'll take up audit objectives. Audit objectives. Auditor objectives. Auditor objectives. Auditor objectives. So class, we have got two main categories of audit objective. Ya kwanza tuko nao tuko the primary stroke the statutory audit objective. The primary stroke the statutory auditor objective. The primary stroke the statutory auditor objective. The primary stroke the statutory auditor objective. The number 2, we have the secondary stroke incidental audit objective. The primary stroke incidental auditor objective. The primary stroke secondary stroke incidental audit objective. The secondary stroke incidental audit objective. So to go to primary, then you have the secondary auditor objective. So the primary objective audit is the main reason why an audit is normally done. So the main purpose or reason why an audit is normally done, which is to express audit opinion, to express auditor opinion. Allow secondary as a byproduct of audit work. Secondary, the byproduct of audit work, like prevention and detection of errors and fraud, is a secondary audit objective. Providing management advice is a secondary auditor objective. Is a secondary audit objective. Okay, so after doing that, we are now through with the introduction of audit world. So we need now to begin with the topic 1, which is assurance and non-assurance what? Engagement. So that one to find in our next lesson when we shall be meeting. So do you have any question? Any question? Any question? Ad hoc. The same as ad hoc. audit. Okay, if we're to look at our audit, it depends on what are we doing, what are we examining, what do you want to achieve. There are several audits, even there are some that we haven't mentioned here, like a system review audit, procurement audits. Still, yeah, so if you talk about ad hoc audit, it comes from the term ad hoc. You must have understood what's meant by the word ad hoc. That's something which is not planned. Still, there was no prior arrangement. It's like a surprise basis. Yes. So it could be maybe investigating the management through that ad hoc. So it can also still falls under the management audit. Okay, sawa. Sasa najua mmechoka sawa, si ndio? The day has been long, the week has been long. So we can end there unless if there is any question. Kuna, you can call it an evening. Then we meet next time. So enjoy the rest of your evening. See you another time. See you another time. Ruth is saying tomorrow. Okay, so inshallah. Is there a recording? Okay, I think so. Wajamaa kwa nasema mwalimu amesweat. Wajamaa kwa nasema mwalimu amesweat hapa. Sijui alikuwa ni nani? Someone hapa. Anaitwa BM. So I'm just wait on this oily. So you're free to go home. I'm on another class. Okay, so we're gonna was class not supposed to be beginning at 6. I think as per the timetable, it's 4, no? Not 6, it's a 4. Okay, so straight.
Ukikuwa hivi wanakisikia
hivi
wanakisikia